Hello, good morning, and we are live. And good morning to everyone. Thank you very much joining us today on Money FM on Behind the Markets. And today is the Enterprise Thursday edition, where we shall be going through two big questions. One is about team building, and the second one, the main one actually, is about 10 signals that the supply chain is actually improving. I'm your host, Munyumba Mutwale, and I will be eventually joined by my host, Stephanie. But today, I'll be taking you on this cruise controlled mission through your market analysis. So let's get down to Enterprise Thursday, 27th of July. Welcome. And if you're watching this today, give us a shout where you're joining us from, what's your name, where you're joining us from. Tell us where, also tag one of your friends, share this with your friends. As remember, they also need to make sure that they're in the know as to what is happening in the world of business and enterprise. And let's get down to it. Right. So today's market roundup, we are seeing that the Kwacha did close yesterday below 19. Up 2.69%. There has been a strong appreciation of the Kwacha over the past few days. We're trying to pick up where the source is coming from, or whether it's just also residual effects from some of the bond auctions that took place last week. I remember that some of these banks are obviously having to now start doing pre purchases for their clients as well. So that also requires some of that to be done. So you can actually see that about 18.72 is where the Kwacha closed yesterday, 2.69. So this could also be some internal settlement happening at the same time. 2.73%. The Kwacha is stronger as well this week, and on the last 30 days. It has shaved off some of the gains, and the year to date, the dollar is only up 3.49%. It is still in buying posture, but we are seeing some selling, some strong selling happening. We did see that the stock market yesterday did take a secondary dip yesterday, as we did see some selling on Zambeef shares. Down 0.8% on the week, down 0.2% even on the month. So in the last 30 days, we have seen the stock market perform relatively negatively as we await for results season to kick in. Remember, we've got banking results. We've got general results coming in. So we're going to have general bank earnings coming out in the next couple of weeks. While we're going to have general results also from about 14 listed companies. We'll give you our half-year results coming out over in the next month. Especially scheduled between August, going all the way into September. That's when we're expecting to see the close of that. Bond index up 0.1%, and then dollars up 3.57%. So for Zambians offshore, you are winning at the moment. But interest rates also came down by 0.01% yesterday, by 1 basis point. So this, as we can see, we've been through this kind of sine wave dive where we went up to 19, we went up to almost 20. In fact, we crossed 20, and then we came, and as we started to approach 19.5 again, we took a nosedive as well. So you can see that there is a wave that's happening on the Kwacha itself versus the dollar. So we are seeing that's why we are seeing what should be an acceleration starting to trend downwards. Now against the rand is where we are also seeing about a 3.27% dive as well. On the week, it's down 2%, and on the month, it's down 14.6%. It's up 14.6% as the rand is. That's danger for cross-border trading. But year to date, we are still seeing that the rand is still weaker. Acceleration, obviously, the rand is still in a bit of an acceleration, and it's above its 200. It's trading above its 200-day moving average, where the dollar is trading around its 200-day moving average, almost correcting straight back to that. Now, in terms of the GRZ bond index, 15.2% year to date, up 1.96% on the month. This is actually good. It's a good and steady rate upwards. While we're seeing the US dollar version down 6.4% on the month, up 3.57% yesterday, and up 12.1% year to date. We are seeing that even year to date, the interest rates are still up 0.48%. But as we're slowly and steadily sliding back downwards. The problem with the interest rates is there's always a sharp uptick, and then there's a staggering slow decline downwards. So on the net, interest rates are actually up. Now, in terms of copper prices, this has been a little bit of a bungling session, but over the last 2 months, we've seen copper prices rebounding back to 8,600. Yesterday, they traded negatively about 0.72% on Fed data. Remember, we were waiting on the Fed news yesterday where the Federal Reserve did raise interest rates, up 1.37% on the week, up 20.83% on the year, and up 2.86% year to date. Oil also went down yesterday, 0.42%. down 16.46% on the year and down 3.63% year to date, while gold was up 0.33%, up 7.96% year to date. So it has been a defensive year altogether. If we look at wealth insurance assets in general, cryptocurrency, Bitcoin was down 1.9%, Ethereum down 1.7%, and all these were a result of the Kwacha trading stronger by 2.6% and gold down 2.3%. Remember, these are wealth insurance assets in Kwacha. Okay, in Kwacha, not in dollars, in Kwacha. So you can see year to date, Bitcoin is up 82.55%, but down 4.42% on the week. Ethereum also up 60.44%, but down 4.23% on the week. And gold is up 11.73% year to date, but down 2.7% on the week. And this just shows you that these are highly, highly volatile assets. And that's why I keep saying, keep them to a minimum exposure in your portfolio. Now, if you're taking a look, remember that we're waiting on inflation data today on the expectation that inflation will move up slightly. Remember that July is actually meant to be one of the most deflationary months, but we are seeing a little bit of inflation pressure picking up, especially in the food price sector. Now, July, in terms of where we are right now, 26th of July, we're seeing that bonds are still up the highest in terms of the conventional assets, 15.2%, stocks are up 12.1%, and the dollar only up 3.5% year to date, with 11.7% on gold. Bitcoin up 82.5%. Remember, this is all results of the first quarter gains, and Ethereum up 60.4%, also a result of the first quarter gains. Second quarter, these things lost, and they're just struggling to get back their ground and their footing. So this is very, as I said, extremely volatile. The majority of one's assets should always sit in their stocks, bonds, and their real estate, while the dollars, gold, Bitcoin, and Ethereum are what we call hedging instruments to help against any turmoil coming later. Right, going a bit further, we did see that our wealth, also our four horsemen did give us strong indicators. Crude oil inventories dropped by 0.6%, so that puts pressure to push crude oil prices up. Japan's leading index is showing that their economic growth prospects are starting to slow down. While on the interest rate side, we are seeing that the money supply in Europe has slowed down in growth. Loans have slowed down, and private sector loans have also slowed down. So we are seeing a slowdown in the growth of loans in general. Italian 6-month notes also traded upwards in terms of interest rates. Mortgage rates stayed the same, but the Federal Reserve did push up its interest rates by 0.5%. Now, those seem to have been priced in. It's the outlook that they're still fighting inflation that is causing issues in the market. Now, the MBA mortgage applications also dropped by 1.8%. Mortgage index dropped from 163 to 159 yesterday, and also mortgage market index also dropped from 210 to 206. With mortgage refinancing also dropping from 446 to 444. We saw building permits coming down to 3.7, dropping by 3.7%. New home sales dropping by 3.7%, and Chinese industrial profits are also operating lower than where they were last year. So we're seeing industrial weakness. Interest rates are still elevated. Inflation is has still got a little bit of stickiness to it, but it's trending downwards, but still got some stickiness to it, and weak economic growth prospects. And this is all lined up with the fact that this year is really going to be the economic slowdown that it has been sold to be. Now, the first thing that I wanted to touch on today was for those who are running into their businesses. The first thing we wanted to look at today is where are we standing in terms of even our oil market. So this is where we are in terms of our prediction for oil prices by the end of the month. And that's going to be on Monday. Monday is when we're going to see here the ERB announcement. And this is where we stand right now, expecting oil prices to be up 1 kwacha and 3 ngwe, up 4.14%. Back to 25.96. What is the key driver of that? Global Brent prices are up 6.35%. So that should drive petrol prices to go up. So we're still waiting on some of the interventions by the ERB and the changes that we're expecting to be made going forward. But this is where we stand so far. 6.35% increase in Brent prices is what's going to put a bit of pressure to see a 4.14% or around there. That's our estimation, a 4% increase in pump prices. So take a look at it very carefully. We'll probably start to see signs of this happening. So S&P Global actually did a study recently to start saying, or not a study, but they released a paper recently that's actually pointing out that we are seeing a recovery in supply chains. So they have noted 10 data points that are here to support the fact that supply chains are recovering globally. Now, with global supply chains recovering, one of the things we should actually be looking for is what this will do for inflation, because a recovery of supply chains actually means improved inflation prospects. So that's what we really want to pay attention to. So, and what we simply mean is that the price of things will not be as high as we expected. The price of things will not be as high as we expected. But before we jump into this S&P analysis, we do have one question from yesterday. Jebby Spiri has asked, "Good morning. I enjoyed yesterday's Wealth Wednesday, and the breakdown you did of Real Estate PLC was on point. Now, if all approved, with the share price and market cap increased according to the rise in revenue, if all is approved, with the share price and market price increase according to the rise in revenue you projected. Thanks." All right, thank you very much. I think that was more of a note. You're welcome, guys, and that is why we do our analysis. It's to make sure that we give. It's to make sure that we give you the best of. It's make sure that we give you the best of what is going forward. It's to make sure that we give you the best of what is going forward on the market. Now, let's touch down going forward. Now, the supply chain, and I think the follow-up question is, will the share price and the market cap increase? It is in line with fundamentals. To the people who are listening, in line with fundamentals, it is possible. It's highly possible that the share price and the market cap will actually increase. And the main reason that will be the driver of that will be the main reason that'll be the driver of that will be the profitability will increase, and also the potential to pay dividends will probably increase. One of the key drivers of more shares being purchased in Zambia or share prices going up is when dividends are paid out. A lot of the institutional investors use those dividends to buy the shares of the stocks that actually pay out dividends, and also those that tend to grow very strong, but they really are more concerned with consistently paying dividend stocks. That's been the driver for them. And also that the thing specifically about real estate investment Zambia is that it's a very strong proxy for property holdings. So it becomes an equity that, yes, may not stand as an equity holding, but it becomes a very strong proxy for for property holdings for the institutional investors. So my expectations is that should this convergence go through, and all that I have pointed at, it should go right. Now, my key concern is still, what is the nature of the transaction? So there are some underlying issues inside that transaction that we need to look at. One, what will it cost real estate? What will it do to the cash position of real estate? Will it put them in heavy leverage? How are they going to acquire this? Because we haven't seen how the consideration is going to be paid. What is the price of the properties that they're going to take on? Okay, what are those? Those are huge properties. And yes, it is the largest shareholder in real estate, which is LM&C, who now owns 59% of real estate investments. They are basically the ones consolidating their portfolio in. Is this going to be counted as a merger? Is it going to be counted as are there going to be extra shares issued? What is going to take place? This is a material difference. Because we did also already go through a rights issue where funds were raised. Are those funds raised going to be adequate? And then also, what's the leverage position on those assets? Is real estate going to take up some of those? So there is quite a lot of information that we still need to go through in terms of that. And a circular will be issued out to understand this deeper. But on the surface of it, on the face value of it, it does look like it will be a positive trade-off. The reason I say this is when something quadruples the revenue base, because effectively that is what's going to happen, you will see real estate investment revenue go up from $260,000 a month in terms of rental revenue or about $3 million a year in terms of rental revenue, close to about $11-12 million a year in terms of rental revenue. That is a big change to the face of the company, and potentially moving it towards that billion kwacha status, just even under the underlying assets. So it will end up being a heavily underpriced stock should they not be massive leverage, or should they not be a distortion. But it will look like it will be a heavily underpriced stock going forward. Right. Thank you very much. And hopefully that answers your question. But yes, it does look, in my case, it is holding to be what I call a strong buy. But it's contingent on knowing a lot more. So there we go. Right. So let's take a look at some of the supply chain issues. Now, supply chain issues are good for the people who are doing business, and also good for tracking inflation. Right. Let's take a look going forward right now. Now, we are seeing that one of the first notes on the first data point on supply chains is that there's a negative 16% change in seaborne imports versus a year before earlier. This is H1. Now, remember, the reason why there was supply chain backups is because everyone was pushing in order. So in the first half, weak demand for consumer discretionary goods in the US led to a 16% fall in seaborne imports compared with the previous period. US containerized freight imports increased 5.5% year on year, and that will increase 5.5% in the third quarter, and the fourth quarter 2023 will also slow, and the fourth quarter before slowing down to 3.7% in 2024. Now, what you can see is generally what happens is you start to see, in terms of generally, you do see a spike and a pickup, and then a slowdown in imports. In imports. So they're saying that the seasonality levels of consumer goods shipments are back to where they were at pre-pandemic in terms of the cycles. So they were really high before, simply because supply chains were closed up. But now they're back to where they were before. So you can see that the levels, the amount of imports that are needed have started to come down. So consumer goods imports and shipments have started to come down, because it looks like supply chains, even in America, are starting to recover. So already that is less inflation pressure that is being put on the market. And this is also what's probably contributing to China. And they've also at April 2009 was the last time manufacturing supplier delivery times were this fast. Delivery times through the global manufacturing goods in May were the fastest that we've ever seen since April 2009. The reduced demand and reduced orders of manufactured goods gave supply chains a much needed opportunity to de-bottleneck. So this is what's been pushing prices of things up. Bottlenecks in supply chains. And this is what's also causing rising interest rates to continue threatening. So S&P has pointed out, this is the second data point, and we're seeing that the latest figures in June 2023 indicate a slight slowing down. So basically back to March 2023 levels, and this indicates a rationalization of capacity by shipping firms, as well as an end to inventory reduction. So this is also why we're seeing that there is an increased speed of delivery of products. So product delivery is starting to come back to full steam, regardless of which products they were. So product supply times are starting to pick back up, and this is the fastest that we've seen since 2029. We've also seen that containerized freight costs are at $1,050. Containerized freight costs have returning from stratospheric levels during the pandemic. If you remember, containerized, in other words, shipping container costs were costing the highest that anyone had ever seen at record levels. So according to S&P Global Commodity Insights, shipping costs from North Asia to North Europe and US West Coast fell from 1,050 per 40-foot equivalent unit in June 30 and slid 28% in price from the beginning of the year for Europe, and 22% to the West Coast. So year to date, we're starting to see the price of containers, meaning that there is not a backlog anymore. The direction of shipping rates is partially a function of capacity discipline. The Journal for Commerce reports that the capacity could increase by 19% a year on year by the end of August. And it's worth noting that North Asia to US West Coast has averaged about 1,500 in terms of freight costs as well. So in other words, the cost of putting things on shipping containers is actually coming down by about 22%, meaning supply chains are starting to ease up again. And you can see that price was really getting up to the roof. We're talking about when there was that Suez Canal crisis as well, adding to all of this. We're talking at about $18,000 from getting from North Asia to Europe, and we're talking getting close to $10,000 to getting from North Asia to the U.S. West Coast in terms of that. So supply chain pressure is expected to come down. Again, one of the other factors that we've seen is that there's 28.8 million year-on-year light vehicle sales, including ISC region. We have seen that global auto sales have steadily recovered and reached 28.8 million vehicle sales from January to May 2023. This is a 9% growth year on year as production and inventories have recovered after pre-pandemic shortages of semiconductors and other components. Sales in Europe are up 16%, China up 10%, North America up 6%. However, that left total sales 10% lower year to date than where they were in the same period in 2019. So we haven't experienced a full recovery, and this mainly because that we're still resolving some kinks in the global supply chain, and financing costs also could be high because of demand issues. But right now, the auto supply chain around the world seems to be heading towards recovery as well, as you can see, as shown in the chart. We're also seeing lithium carbonate sales from mainland China. The delivery of lithium carbonate, a key mineral in manufacturing of lithium-ion batteries used in electric vehicles and consumer products, fell to 20.4 per pound in March 2023, down from its peak of $35.8 in December 2022, according to S&P Market Intelligence. While there's an elevated demand for critical minerals from the auto sector, we are also seeing that while there is elevated demand for the critical minerals in the auto sector that will come over the decade, as discussed before, the battery magnet IRA and the mineral supply chains, a drop in demand is expected due to consumer goods. So currently, we are seeing that even lithium carbonate, which has been a signal of also some of these supply chains and the holdup, is actually starting to slow down in price. The other thing we're seeing also is that export of integrated circuits from mainland China and Japan and South Korea and Taiwan combined, they fell a combined 22% year on year in May to $34.1 billion. This was the lowest month since 2020. A slump in demand for computer and telecom sector for a basic processor and memory chip was mostly to blame, shown by a 36% slide in exports from Korea, and which is specialized in memory chips and shipments for the processor, including AI-focused graphics chips, were more robust with a drop of 8% in Taiwan in total exports. So what we're seeing now is, remember that we've been having problems with semiconductors, we've been having problems with integrated chips. These things have been in extreme demand, so they're finally starting to slow down. Exports were well above pre-pandemic levels in May, sitting at 31% over the same month. So this is what we're talking about in terms of total chip shipments. They've started to come down from their peak of 2022. Other thing that we're seeing that's showing that there is a slowdown in the supply, that the supply chain globally is starting to normalize back to 2019 levels, is that the Dutch government also implemented new restrictions on exports of semiconductor manufacturing equipment to mainland China, citing national security considerations. Limited time deal. Mainland China restricted critical because as a result of the fact that mainland China has restricted mineral exports, and this basically follows similar moves by the USA. While showing positive momentum, this largely reflects a weak shipments at the end of 2022. Exports were down 39% year on year and have lagged recovery in exports to Korea and Taiwan. The downturn in turn may reflect earlier advance purchasing by mainland Chinese buyers as a result of the government restriction not suddenly being imposed. So we're actually seeing that there is a 47% decline, 47% growth in Dutch chip making equipment exports to mainland China, to the point where they've actually had to restrict it, meaning that we're probably going to see a lot more chip processing happening there. So that's the growth that we're seeing. For also other news that we've seen, Indian exports of mobile phones year to date is also up. This represented an 85% increase on the year earlier. Only covers the off-peak season of phones. The leading exports obviously has been Hon Precision Industry Co. with 26%, and we're also seeing others as well, but we're also seeing Indian phone exports are finally starting to come back up. I'm just really lining that up. American manufacturing has been a 5.1% US manufacturing earnings inflation. A surge in consumer spending on durable goods during the pandemic increased demand for manufacturing workers, creating widespread industry shortages. Shortages have been combined with inflation and have put labor in a better bargaining position. However, U.S. manufacturing hourly earnings rose 5.1% year on year in the first quarter, according to market intelligence, slightly down from the peak of 5.6% from the first quarter in 2022, but still lagging consumer prices. Basically, this spread between consumer price inflation and wage growth has come at the same time, increasingly, that there's contentions in labor relations, with particular focus on the West Coast ports starting to negotiate. So that's some of the data that we're seeing. And finally, there's been 9.9 metric tons. This is an increase in EU imports of grain and oilseed from Ukraine. So that's some of the data that we're starting to pick up from the market. And we're starting to see some of the grain seeds. So food supply chain disruption resulted from the war in Ukraine, accelerated in the first half of 2023. The interruption of shipping lanes from exporting Ukraine cereals and oil seeds has meant an increase in exports to EU by land, which rose by 9.9 million metric tons from June, from January through to April, compared with the year before, 117% rise. Now, the bulk increase in shipments has accounted for 54% additional shipments. A further 26% arrived in Romania, Poland, and everything. So the point we're trying to see is that the grain supply chains are also starting to return to normal. So basically, these are 10 points that I wanted to just point out to you today that are showing evidence that global supply chains are starting to recover. Why is that important to you? Because people don't think that stuff's important. It's actually very important, because at the end of the day, it actually affects your ability to see prices of things coming in normally. So when global supply chains are backed up and they've got problems, global inflation, and we start importing inflation. So this supports the fact that we're seeing food prices, energy prices, metals prices, and all sorts of prices starting to come down, and therefore the cost of things will start to trickle down with it. So as the business community, that means global inflation pressure is coming in softer. Now, I wanted to just quickly add into the final question here, our answer from Lamek Zimbo said, good morning. Just to divert a bit, how will the impact of DBZ being insolvent have on the market, and what other options do businesses have for cheap finance for capital projects apart from commercial banks, which are available on the local market? Well, to be honest, Lamek, DBZ has pretty much been insolvent for some time now. I think when they noted that bank, 90% of its loans were not being paid back, I think that was already the first death knell that we heard when we first picked it up. So one of the main things that companies have to utilize for capital intensive projects for the meantime, in fact, not even just for the meantime, in general, companies in Zambia utilize their working capital. In other words, they run their businesses, raise their profits, and use their profits to reinvest into their businesses until they can get to such a scale where they can finally start to get more private credit on the market. The problem is, it appears, is that a lot of us don't want to utilize the discipline of funneling money back into the economy, back into our businesses in order to do that. And that's where the problem has been. So that's the option. The option has to be run your books and run your numbers and channel your resources back in. And you have to start, this also is an issue of pricing your services and your products correctly to ensure, and not just to ensure that you can strike the balance between affordability but also sustainability. Okay, you have to do between the two. And also, the owner's lifestyle often has to cut back. So, the companies in such periods of high interest always have to be extremely disciplined and utilize reserves and build reserves to grow the top line revenue directly. And also, it means that companies need to be more strategic about their investment. It's not just about grabbing a hold of capital because there's an opportunity to chase. Now that it's your money and your savings on the line as a company, you have to start making better decisions on how to manage your funds. That's the reality. Now, is that a politically correct answer that makes you comfortable? No, not by any stretch. It doesn't make anybody comfortable. It doesn't make anybody happy. But that's the reality a lot of people in the business world have to face. So yes, and banks like that, unfortunately, were already. It's not even that didn't even cause the issue. That's been the norm for a while. The businesses that grow rechannel their savings and reserves back in, and they manage their funds very well. Right. So everyone, I think this has to be the close of the day. We're not able to go into any other sessions. As we pointed out, supply chains are starting to return. Catch us tomorrow for Futuristic Friday. We should have our co-host back. And to everyone, thank you for the questions today. And I hope you have a blessed and wonderful